24. Buy-side deal breakers. When to walk away. Material adverse change and undisclosed liabilities. Material adverse change events. Material adverse change provisions allow buyers to terminate deals when target business deteriorates significantly between signing and closing. MAC clauses protect buyers from events like loss of major customers representing substantial revenue, regulatory actions threatening core business operations, litigation outcomes creating material financial exposure, or key management resignations undermining operational continuity. Sellers resist broad MAC definitions while buyers seek expansive protections. Delaware courts interpret MAC clauses narrowly, requiring significant long-term impact, not temporary disruptions. The COVID-19 pandemic tested MAC provisions, with courts generally rejecting buyer termination attempts based on industry-wide impacts. Undisclosed liabilities discovered in due diligence. Hidden liabilities discovered during due diligence frequently cause deal termination. Environmental contamination requiring expensive remediation makes properties unmarketable and creates ongoing compliance obligations. Unrecorded debt or off-balance sheet obligations increase effective purchase price beyond acceptable levels. Intellectual property disputes threatening product sales create existential business risk. Tax assessment notices indicating underpaid historical taxes generate contingent liabilities. Buyers must evaluate whether sellers can cure issues, whether price adjustments adequately compensate for risks, or whether risks justify complete deal termination. Strategic misalignment and integration impossibility. Due diligence sometimes reveals strategic assumptions underlying deal rationale were incorrect. Assumed customer synergies prove unrealistic when customer contracts contain anti-assignment clauses preventing transfer. Technology integration requirements exceed initial estimates, making combined operations uneconomical. Cultural assessment identifies irreconcilable differences in management philosophy, risk tolerance, or operational practices. Buyers must honestly reassess strategic logic rather than proceeding with flawed deals. Valuation gaps and financing failures. Insurmountable valuation disagreements. Quality of earnings analysis sometimes reveals EBITDA significantly lower than seller representations. Sellers adjust EBITDA for items buyers view as recurring expenses, not one-time costs. Revenue recognition policies prove aggressive, inflating reported performance. Customer concentration exceeds acceptable levels, creating revenue sustainability concerns. When adjusted valuation falls outside buyer acceptable range, price renegotiation attempts may fail, causing deal termination. Financing commitment withdrawals. Buyers relying on debt financing face deal failure risk when lenders withdraw commitments. Debt markets can deteriorate between LOI signing and closing, affecting lending appetite. Due diligence findings cause lenders to reassess credit quality and reduce committed amounts. Target financial performance declining during due diligence triggers lender covenant concerns. Buyers using committed financing include reverse termination fees, compensating sellers if financing fails. Regulatory rejection and approval conditions. Antitrust clearance denials. Competition authorities may block deals, creating market concentration concerns. In the United States, the Federal Trade Commission and Department of Justice review transactions under Hart-Scott-Rodino Act. European Commission reviews deals exceeding revenue thresholds under EU merger regulation. Regulators can require divestitures of overlapping businesses as approval conditions. Required divestitures sometimes eliminate strategic rationale, making deals uneconomical. Foreign investment security reviews. CFIUS reviews foreign acquisitions of U.S. businesses involving national security considerations. Deals involving critical infrastructure, sensitive technology, or proximity to military facilities face heightened scrutiny. CFIUS can impose mitigation measures restricting information access or operational decisions. Some buyers withdraw rather than accept operational restrictions, eliminating synergy potential.